The purpose of this video is to help home buyers understand what PMI is, why it's necessary, and how to get rid of it. My name is Bryan Wallpe, and I'm co-founder of Mortgage Upside. I have over 30 years of experience in the mortgage lending business. I have a background as a CPA, and also I'm a financial coach. So our goal at Mortgage Upside is to help people make really smart financial decisions when they're buying a home and then also during their home ownership journey. So PMI stands for private mortgage insurance. And that is an insurance policy that the lender takes out to protect themselves, that you pay for, by the way. And when your down payment on a purchase of a home is less than 20%. Now, that's generally on conventional loans, VA loans and FHA loans, government type loans and USDA loans have a different form of PMI, but they also have an extra premium when you don't put 20% down. So essentially, if you're putting down less than 20%, you have a slightly higher risk to a lender that you may default on your loan and they might have to foreclose if you stop making payments on your loan. So in a perfect world, the lender says put 20% down and I'm going to give you an interest rate with no PMI. So people say, how much do I have to pay? And that has everything to do with a few different characteristics. One is how much you're putting down. So in other words, if you put 5% down on your purchase, your down payment's 5% down, then you're going to be paying a higher insurance premium than somebody putting 15% down or 10% down. So the amount of your down payment percentage matters. And generally, it'll go in like 5% increments. You can put as little as 3% down. And that's a very high mortgage insurance premium. Then you can do 5, 10, 15% down. So that matters. Your credit score probably matters the most, right? Because if your credit score is real low, you're going to pay a lot higher mortgage insurance premium than if you had really high credit score, which I think the top is still 780. So know what your credit score is. That's a really important thing to manage and try to improve as best you can. So we have other videos on that. A third category is the type of loan you have. So the type of loan meaning a fixed rate loan or an adjustable rate loan. So you're going to have a lower in mortgage insurance premium if it's a fixed rate loan versus an adjustable. Why? Because a fixed rate loan we know what that payment's going to be, right? There's no variability in that payment. If you have an adjustable rate loan, your payment can actually go up, causing you to be more risk to the lender, right? If your payment goes up, the insurance company thinks it would be higher risk. So for a fixed rate payment, it's lower PMI. So the final category would likely be the loan size. The higher the loan, because PMI is a percentage of your loan amount, the higher the loan amount, the more expensive your PMI is. So, and it's generally somewhere in the neighborhood of 0.3 to maybe even as high as 1.5% and that's annually of your loan amount. 0.3% to 1.5% of your loan amount can be your PMI. So you can see people with a $500,000 loan and their PMI might be $500 a month. So let's talk about the ways that you can pay for private mortgage insurance. So the first and by far the most common way is to pay for it monthly in your mortgage payment. So they just add a monthly amount, again, based on all those factors we talked about. And it's a dollar figure that they just add to your mortgage payment. So that's the most common. Another way to do it is we'll call it lender paid PMI. And that's when the lender actually increases your interest rate to pay your PMI. So invariably, it's kind of the same thing, right? If your interest rate increases, your payment increases. And so that's how you're paying it. The tricky part about lender paid PMI is it stays with your loan. So because your interest rate is going to be higher. So a third way is what they call a single premium PMI, like you pay it all up front. So, and it's a big number. So, and again, it depends on if you're putting 5% down or 15% down. The less you put down, the more expensive that single dollar figure premium is. And so basically you're paying for your insurance policy in advance. So, and a lot of times Some buyers will have the seller pay that big premium. So, and that can be a very helpful way to do it. So there's some creative ways to make all this happen. And so that's why you want to talk to a mortgage professional like me. So those are some of the ways you would pay mortgage insurance. Sorry, got an itch. All right. So let's talk a little bit about how you get rid of mortgage insurance, because that's the goal, to get rid of mortgage insurance. So the first way to get rid of mortgage insurance is, and this is a federal law, is to over time pay your loan down, and it'll automatically come off when you get to 78%, when your loan gets to 78% of your original purchase price. So on a $100,000 purchase, when your loan gets down to 78,000 in that example. So another way to do it is when you think your loan is at 80% of your original purchase price, you can call the lender and say, hey, I'm at 80%, I'm at 80,000 on that example of a $100,000 purchase. Please remove my PMI, and they will do that. So they'll do that. They're required to do that. A third way is, what if your house appreciates, right? Paid $100,000 for it, and let's say it's worth $120,000, you're going to be able to remove your PMI. However, there's a catch. You call the lender and say, hey, my house is appreciated. My loan, let's say, for instance, you put down 10%, your loan was $90,000, and maybe you appreciated pretty quick because you got a good deal on your purchase. So let's say you've paid it down $5,000, you're at $85,000 on your loan. Now you're from a lender standpoint, you're still at basically 15% equity from the original price of 100 at 85,000, but your house has gone up even as little as $10,000. You can call them and say, hey, I feel like I'm at 80%. I have 20% equity in my house, if not more. And they'll probably tell you to go out and get an appraisal. Sometimes they have automated valuation models that they'll do, but the likelihood is they would say, please go get an appraisal and prove what your value is. So that's what you would have to do, is pay for an appraisal. But that's how you can get rid of mortgage insurance. So let's say, for instance, your appraisal cost is $500 and your mortgage insurance every month is $100, right? You're going to pay back the cost of that appraisal over 5 months in that example. $100 a month for 5 months is $500, the cost of the appraisal. So that can make sense to do sometimes. Another way to get rid of your mortgage insurance, the last way, is to refinance. So hopefully the interest rates are lower when you're refinancing, right? But I've seen it done a couple of times when the rates were about the same and people would refinance to get rid of their mortgage insurance premium. So it just depends on the circumstances. But if your home is appreciated and then you refinance your current balance into a new loan, that new loan will essentially you'll have 20% equity in your property, and you will not have to have mortgage insurance on that because you'll have 20%. So that's the key, that 20% mark. So, some people say, private mortgage insurance, PMI is evil. I don't want to pay PMI. So it has for obvious reasons, it has a negative connotation because it's an insurance premium you pay. But think about it. Most homeowners, when they're first time buyers, right, generally utilize that, right? It's hard to save 20% of a purchase price, especially in today's world where, homes are expensive. So essentially what you want to do is you can get in with PMI, and then you just work really hard to pay your loan down. You can pay extra payments. You can do things like that to pay your loan down to get rid of that mortgage insurance ultimately. And then hopefully, which is traditionally the case, your home just kind of creeps up in value every year. So PMI is not the end of the world because you can get rid of it. So I would say it's better to buy a home in a lot of cases with less than 20% down than to wait, because it could be years, right, of waiting and saving to be able to buy a home. And you're going to, it could be that you're buying a home today with 5% down, a home that might cost $400,000. And if you had to wait to get 20% down, say you waited 5 years, that home's going to cost you, $500,000. So the challenge is you could have bought it $400,000, paid PMI for a little while, and then not had to pay $500,000 for that home and save 20%. So the key is making the right financial decision. And that's what we do. We will help you make those good financial decisions and come up with creative ways, maybe even to get to that 20% down. So thank you for watching, and we'll get you on the next one.